Hi, everybody. My name is Travis Horr. I am the Director of External Affairs at Better Markets. Thank you for joining us post-lunch. I am joined with John Donenberg. John Donenberg serves as the Democratic Staff Director on the Senate Banking, Housing, and Urban Affairs under Ranking Member Elizabeth Warren. Prior to the Banking Committee, John worked in the Biden administration as Deputy Assistant to the President and Deputy Director of the National Economic Council, where he covered issues ranging from technology and financial regulation to competition and small business. A dedicated public servant, John has served in a variety of government roles, including Chief of Staff to Senator Elizabeth Warren, Chief Counsel to Senator Blumenthal, and as an aide to Chairman Henry Waxman on the House Energy and Commerce Committee and the House Oversight and Government Reform Committee. And he served as a law clerk to Judge Henry T. Edwards of the D.C. Circuit Court of Appeals. He is a graduate of the University of Illinois, University of Cambridge, and Yale Law School. And thank you very much for joining us today, John. He's going to give a few remarks on the priorities for Senate Banking Committee and the Ranking Member Elizabeth Warren, how academics and people in this audience can better engage with the committee and support each other. And with that, I'll kick it over to John. Thank you.
Great, thanks, Travis, and thank you, to Travis and to Amanda and Dennis and all of the Better Markets family for having me and for really pulling together this conference. I think it's great to pull a bunch of people into one room who don't always get to spend time talking to each other and really dig in on some of these issues at a moment of, we'll say, great interest and great upheaval in economic policy and also financial regulatory policy. So as Travis mentioned, I'm the Democratic Staff Director for the Senate Banking Committee, which is a committee with fairly broad jurisdiction across the economy. Of course, we are responsible for legislation and oversight relating to financial regulation, banks, capital markets, but also broader questions of monetary policy, inflation, and a whole bunch of other issues that are sort of shoehorned into the jurisdiction of the committee over time, which include housing policy, urban transit issues, and a variety of issues that are sort of at the intersection of international economics and foreign policy. So in particular, sanctions issues and export control, outbound investment, these sorts of things. So I'll probably focus mostly on the domestic side of the ledger for this conversation. But if people have really burning questions about, Russia sanctions policy, I'm happy to answer those as well. I thought maybe I'd open just a little bit on, where we see the state of the economy right now and how that's sort of informing our policy approach from the Democratic side of the dais in Senate banking, and then talk a bit about Senator Warren's priorities. Some of these things, many of you are tracking in detail. Probably few of you are tracking all of them in full detail. So I'll just try to slightly skim the surface, and then we can do follow-up questions and dig in on some of the issues. So, first, I think the perspective of the ranking member and certainly staff on the banking committee is that we're in a pretty precarious moment for the the national economy coming out of the Biden administration into the new Trump administration. We had seen inflation moderate from its peaks. We had seen the job market sort of stabilizing. We weren't quite at the Fed's target rate, but we were sort of moving in that direction. Unfortunately, we have seen dramatic shifts in federal policy, and as a result of those shifts, as well as I think probably some underlying, issues in the economy, we're really running into some headwinds now. And so, core PCE, for example, in January of this year was at 2.7%. Now it is at 2.9%. PCE overall was at 2.5% in January. Now it's at 2.6%. And, we're seeing that sort of tick up in inflation over the window at the same time that we're seeing weakness in the job market. And this is not just a function of some of the revisions that we saw over, for the last annual window, but we're also seeing it in the monthly prints as well. The sectors where we're seeing job growth have sort of shrunk over time, and currently it looks like, at least in the early prints, we're seeing growth in healthcare, and that's about it. Which is quite problematic. And I'm sure all of you have seen some of the data about, the sort of unstable equilibrium that's happening right now in employment, where, job seekers are having an increasing difficulty. Companies are not firing, but they're not hiring either. So, that is the context in which we find ourselves, I think, from the perspective of the ranking member of the banking committee, and she's been pretty vocal about this, a lot of what we are seeing in our view is driven by administration policy. Obviously, there is the tariff policy, which has created tremendous economic uncertainty and also, is starting to drive up input prices for businesses. And we're seeing that, in the Fed's data. At the same time, there is a broader set of economic policy this administration is implementing, which we think really creates a drag on business growth. It's creating a drag on, on job creation. And, in light of those headwinds, one thing you could do, and you have a bunch of academics, look at the data and look at what you're doing and then make a different choice. That is an option for the administration, but unfortunately, we're not seeing a lot of self-awareness around those policies. And instead, what we have seen is a sort of campaign to find other people to blame for the results of the policies. Most notably, I think, as is getting a lot of attention, there are questions about the Federal Reserve, the president attempting very ostentatiously to beat up the Fed every 5 minutes on the internet. If only you would, follow whatever my political whims are at any given moment, like that would solve all of our economic problems. You talked a bunch earlier about Fed independence. I'm happy to answer some questions about that as well if you're curious about some of the perspective from inside of Congress. But, suffice it to say, whether or not the president is successful at cabining the Fed's independent ability to set monetary policy, the wrong solution won't solve the problem, right? And I think you sort of see that in, in what came out of the FOMC just this week, and in the economic fundamentals. The Fed is really stuck right now between making choices that could lead to increased unemployment in ways that would be hard to reverse, or stepping back off of actually controlling inflation over time. And the solution to that would be to fix fiscal policy. So until we get some indication of that, I think we're going to be, in rough waters. On the other side of the ledger, from the macro economy, are questions of financial services industry, financial regulation, our financial markets and capital markets and banking. In these areas too, and I know we have a lot of nerds in the audience that I'm sure would like to nerd out on these topics later, and I'd be happy to do that with you. But suffice it to say, I think the market environment and the regulatory environment in a lot of ways show parallels to what we saw in the late 1990s, in some ways to the mid 2000s. You see a lot of systemic risk potentially building up in a lot of different areas. Shadow banking is really exploding. There's additional concentration of risk in ever more complex financial instruments. And crucially, as we have seen in the past, one of the characteristics that is repeating itself is that that risk is building up in places where we don't have great understanding or visibility into the level of interconnectedness across the economy and what's happening, underneath the hood. So, we all lived the experience of, derivatives and credit default swaps in the mortgage crisis. I think we look today at things like, the explosion of private credit and private equity, not really knowing what's happening, under the hood in some of those, in some of those investment firms is really problematic. As I'm sure many of you know, before Senator Warren was Senator Warren, she was an expert in corporate bankruptcy. You taught at Harvard Law School for a number of years. And one of the things that you are required to do if you work for Senator Warren is also become at least a little bit of a bankruptcy nerd. I'm glad that I wasn't in the class, I would say. But, one of the things about corporate bankruptcy across the system is that it provides visibility to regulators about what's going on, right? So you can see if there's a particular stressed sector, right? What's occurring. So, for example, there's been a lot of conversation in the last year or two about commercial real estate stress, right? We see that in part because of what's happening in the bankruptcy system. We don't know what's going on when a whole bunch of companies that are in the real economy are bought up by these private equity firms. And there's, we are starting to see early indications that maybe the promised returns are not there, right? And, that's going to be a real problem for pension funds that have bought up a lot of this stuff. This is going to be a real problem for the underlying businesses. The incentive structure is also kind of weird, right? Like the design of the corporate bankruptcy code is intended to encourage distressed companies to avail themselves of these systems in order to salvage as much as you can of the business and keep it as a going concern. The incentives for transparency and fixing those problems are completely reversed in the context of many of these private equity firms. So, that's just one example of a number of areas where I think we see, sort of systemic risk potentially building up in the system and are quite worried about what we can see and what we can't see. And, in this kind of a moment and at this point in the business cycle, what you would want to see from federal regulators is an attempt to bring more transparency to these markets, an attempt to have, clear, simple rules that everybody can follow where which side of the line that you're on, and some basic efforts to try to reduce, misunderstood levels of interconnectedness and some basic efforts to ensure that there's like investor and consumer protection as you move into, shakier waters. Don't have to tell everybody here, we are seeing basically the opposite of that. The Trump administration is somewhat ostentatiously firing regulators left and right, even the folks who remain, in those roles who are not political folks, I think, feel the shift in the environment. You get a lot of headlines around freezing CFPB or attempting to fire Lisa Cook for pretextual purposes, but, dig under the hood and you got to worry about what's happening in supervision, not just what message is being sent, but the sort of consistent effort to try to figure out how to just shut down big chunks of the civil service, whose job it is to make sure that, that our banking system is safe and sound, right? And so, like the combination of those things is quite worrisome. Are we going to be able to reverse course on any of this before it is too late? That is a good question that I have asked myself, and I'm now asking myself in front of you. I don't know that I would say I'm overly optimistic in the short run. I think there are a few areas, of potential progress, particularly as it relates to questions around, consumer costs for families, which is a huge priority for Senator Warren and for the Democrats in the committee. I think there are some opportunities around housing, despite the broader environment that I just described. Every senator on the banking committee voted to move, the first major piece of housing reform legislation in over a generation a couple of months ago. I think we have some optimism that will continue to move forward and that it would make some progress, at least on some of the supply constraint questions, and streamlining some systems, to potentially bring down the sort of marginal cost for housing for families over time. It's a drop in the bucket compared to what we need, but it is movement in the right direction. I think on the financial stability side, there is energy around doing deposit insurance reform, which I think would be great. There was a hearing in the banking committee last week, I think, where both Democrats and Republicans across the political spectrum, I think, expressed a lot of openness to trying to fix, what has become a real incentive problem for businesses that need to have revolving accounts. Certainly post SVB, it's pretty hard to make the business case to folks that need to have access to that cash fast, that it shouldn't be in one of the too big to fail banks. Like, that is the problem we should have solved and didn't solve in Dodd-Frank. At a minimum, we ought to do something in order to make sure there isn't a massive flight of deposits out of like small, mid-sized banks, like large mid-sized banks, that creates even further concentration of deposits, and risk in the system. So I think there's some optimism around that. Fed reform is sort of an interesting question. I think the perspective of the president with, on the Federal Reserve is diametrically opposed to that of Senator Warren's on, in some fundamental ways around monetary policy. But I do think, if you take a look at the Senate Democratic Caucus, there probably is not a louder and more consistent critic of, Federal Reserve decision-making and policy, particularly on the regulatory side, than Senator Warren. She wrote an op-ed about this in the Wall Street Journal around Jackson Hole a couple of months ago, talking about a variety of things we could be thinking about doing, certainly on the regulatory side, but I think also, on the monetary policy side, to at least cabin some of the, incredibly broad scope of authority that the Fed has sort of arrogated to itself over time. Which, if you wanted to be optimistic, are the sorts of changes that could, potentially narrow up that mandate in a way that would reduce the Fed's exposure to what I think are mostly bad faith critiques coming from the right, but would make the system, I think, a little bit cleaner and more predictable. So with that, why don't I stop? And I'm happy to dig into any of that or any other topics that are helpful to talk about.
Great. Well, I'm happy to kick off with a question. So one of the goals of the Better Markets Academic Advisory Board was to better connect academics with policymakers in Washington, D.C. So I guess my first question is, what advice would you have to this group to better connect with people like yourself and the ranking member? And, you have a group of potential witnesses here. So if any advice for them and what the ranking member is looking for as a potential witness on Senate banking, and then happy to kick over to audience questions after that.
Yeah, I think that's a really good question. And I guess where I would start is, you hear the description of the kind of like political state of the world that I just walked through, and I'm sure you've talked about this more today, and we all read the newspapers, and you can start to wonder whether or not like facts and ideas actually matter in the decision-making process. And I got to tell you, they really do. Do they matter as much as they should? No, right? Do they always control outcomes? No, but they're critical for being in these debates, and we can't win these debates unless we're in them. And in particular, I would say, if you have the sort of perspective that I know Better Markets does and a lot of the advisory board does of, understanding some of these questions from first principles, being a little bit heterodox about where the consensus is, trying to figure out, don't just defend the status quo, but like what needs to be fixed, right? Or potentially swimming, upstream. The standard, as all of you who are academics who have written that stuff know, like if you're going to write something that goes against the consensus, you better have all your data right. And that is the experience of legislators as well. There are lots for every moment that we want to be cynical about the decision making of members of Congress. I will tell you, there are a lot of people who are really struggling to try to figure out the right answer. And I would add to that that it's pretty hard, actually, for members of Congress to figure out the right answer. They're responsible for voting on and being engaged in every public policy issue under the sun at all times. Their staff sizes are limited, particularly for folks that aren't running committees. And the resources are pretty constrained. That's not an accident. That was done on purpose. It's a concerted campaign across generations to really choke off the investment resources in Congress. You look at what the relative budget of the legislative branch was in the 1990s, versus today. It's like shocking. And there used to be much more institutional knowledge that was built into the Senate, not just staff that had been around for generations, but also additional bodies of sort of academic and substantive experts. The Office of Technology Assessment, for example, was a congressional arm that sat alongside the Congressional Research Service and provided, nonpartisan technical expertise to senators. In the absence of that kind of internal, research capacity and expertise capacity, it inevitably gets outsourced. And the distribution of resources between the folks that have a financial interest in the outcome of what Congress does and the folks, that are just trying to figure out what the right answer for public policy is vast, right? And it's not that, every suggestion that comes in from industry is wrong, right? There are lots of things that can be added to the conversation from voices in industry, but there's a critical function for in the congressional decision-making process for folks to provide information that's not financially conflicted and is just based on expertise and data analysis. So I would say there is a huge appetite for it. Obviously the ranking member has a huge appetite for it. She was an academic. I think she was the first.
It's helpful.
She was the first law professor, I think, to get an NSF grant. So we're very far on the nerd spectrum. When it comes to academic analysis of of data around questions of economic policy. But we do a lot of coordinating of briefings for other members. Either facilitating when individual senators or congresspeople are interested in learning more about a topic. They will often come to us and ask for folks to talk to. And the last thing I should say about it is it is okay to have a perspective, right? Folks will still hear what you have to say, even if they're skeptical of what you have to say. But if you can make sure that your analysis and your data is really locked down, that can be very helpful. The universe of people who we brief inside of Congress on some of these policy questions is bigger than the universe of people that agrees with us on every particular policy question. And that credibility, I think, is something that has been hard won over time, on the part of Senator Warren and also, the team that we've built inside of Senate banking. People trust that the content we're putting out is accurate. And even if they may come to different conclusions ultimately about policy decisions, part of our job, especially as the staff, is to make sure that all the members are fully equipped and understand, the spectrum of issues that are in front of them. And defining the terms of that discussion and that debate is like incredibly important in economic policy generally, and especially in questions of financial regulation, because there's so much technocracy, that can sort of be thrown at the questions to sort of hide the essence of what's going on underneath them.
Great, thank you. Question back there, in the audience?
Thanks. What, if anything, can be done to prevent Democrats on the Hill from being suborned by crypto money? And let me give you background to that. I had a 25-plus year career at the SEC, the last 3 of which I spent regulating crypto. I was sort of invited to leave by the new administration, so I did. As Professor Ferguson explained in a talk earlier, you can see why all the Republicans are falling in lockstep behind the administration's view of crypto. But it's dispiriting as hell to watch so many Democrats fall for that, including my own Senator Warner. And I've tried to go in and speak to him, speak to his staff, and it's like talking to a wall. Is there anything, and it's so dispiriting watching Democrats fall for this. I know your boss is fighting the fight, but what can really be done to stop this?
Yeah, I mean, I think what we've seen, to start with the administration, the approach of the Trump administration to questions of cryptocurrency, I think, are pretty clearly driven by the president's personal financial interests, right? Which is a crazy thing to say, but, don't take my word for it. Read the New York Times any Tuesday. That is a huge, huge problem. And honestly, that's a problem that is not just a source of discomfort for Democrats, it's also a source of discomfort for Republicans. They won't say it mostly in public, but they don't like it. So I do think that there's sort of a ground truth here, which is that there has been such a growth in the amount of assets in this class in the last couple of years that some response is clearly warranted. And I think the question of what that response should be is like hotly contested. And, the ranking member, I think you have seen publicly, is like somewhat dispirited by what that response has looked like so far. We are doing what we can. And I think, we saw this sort of stablecoin bill move earlier in the year. The ranking member, I think, was pretty clear from the beginning that, we are supportive of regulatory regime around stablecoins. Given the amount of money that's in this asset class, I mean, you should set up a system or at least clarify the existing system. But the idea of creating basically an alternative to bank deposits that sits entirely outside the banking system, and in some instances, I guess now sits completely outside of the federal regulatory perimeter entirely, right? It's extremely dangerous, and dangerous in very traditional ways, right? People want to talk about all the different interesting things that you can do with the blockchain. If you have a stablecoin deposit regime that just looks like bank deposits, and now you have financial institutions that are looking at turning on their own stablecoin regimes. Like you may all you're doing potentially is creating up a sort of regulatory arbitrage system where same kinds of actors are engaged in the same kinds of activities, but like without the imprimatur of the federal regulatory system. So the traditional banking regulatory system. And we're starting to see this again, I think, in the market structure debates. There is, embedded in each of these is sort of like two levels of questions. The first question in market structure is like, okay, for existing digital asset classes, what is the right regulatory regime, from a market's perspective? But then there's this second order question there, which is what are we supposed to do with traditional securities that get tokenized, right? Should be controversial that, the same rules that would apply to trading of stock on the stock exchange should apply to trading tokens of that same company on that same stock exchange, right? But in the legislation that's been, has been proposed, the partisan legislation we've seen in the Senate so far on market structure, gaping holes, around this. And so the question you're looking at is not really about, I would argue it's not really about digital asset regulation, which I care a lot about, but it's sort of about whether you're going to de facto dismantle the SEC. And so, I think the job of Senate Democrats is to do what we can to make sure that if there is going to be a reformed regime and a new regime, that regime has the kinds of basic minimum standards for investors and for consumers that you would expect for any asset that looks like this, and not in a technical, sort of like we've invented a new technology and so it needs a whole bunch of new rules sort of way, but what does this look like? Looks like broad-based retail investments. How do we traditionally regulate those types of investments? And what systems are we going to set up so that there is some sort of equivalency there? So I think like those discussions are still ongoing. The Senate hasn't passed a market structure piece of legislation yet. You've seen actually, so far what you've seen is a couple of proposals that are partisan that have come out of only Senate Republicans. Senator Warren put out some of her own principles about what market structure regulation ought to look like. And another group of Democrats, all of whom or nearly all of whom voted for the Genius Act, also put out their own set of principles, which is quite distinct from where the Senate bill is. So, I have some hope that whatever product ultimately makes it out of the Senate will have, will be in better shape along some of those dimensions than what we currently have. And it ought to be possible, right? And I do think that it potentially is possible. Because if we don't do that, then we're gonna, face a real challenge, I think, in our capital markets.
Thank you. I think we have time for one or two more questions. Yes.
I could go without the mic if you like.
Yeah, for the, yeah.
That's right. Could I ask some questions, though, on the international side, specifically on China and relations with the U.S.? And in particular, just look at the auto story. It's clear that Chinese cars are not going to be sold in the United States, I think, anytime soon. Well, then what happens in the walled garden with the American producers who don't seem to be doing a whole lot very constructively? As I read the Detroit strategy, Stellantis being a special case, the big American producers are basically trying to produce for the high-end market. And they talk about the low end, but they're not really interested at all. So, what are we going to get? Ladas in enormous, the old Soviet car. Where is this taking us? And particularly, as it's clear that both the Trump and the Democrats folks have caught on to the fact that there's a North American car market. And it's clear that the Mexicans and the Canadians are going to, one way or the other, whether they like it or not, going to join us in the big walled garden. But then what happens?
Yeah, I think it's a good question. It's interesting that you zero in on the focus of the car makers on really the higher end market. I see that actually as a much bigger, a piece of a much bigger story of what's happening in our economy. That actually you're going to have, I guess you'll have Zandy up here in a little bit who can tell you about the work that he's been doing on this. The Senate Banking Committee put out an analysis a couple of weeks ago that took a look at this real sort of bifurcation of what's happening in the consumer spending side of the economy, and actually Powell talked about this in his in his statement after after FOMC too. So really, I should have been here like 10 days ago, and it would have been more interesting for me to say this then. But there's like a massive split that's happening right now between affluent folks at the top of the market and everybody else. And you're starting to approach half of consumer spending, coming from a very narrow segment of the market. Like that's a huge problem, right?
If I may, though, look, I
Well,
wrote 3 papers on that 3 years ago in a continuous line. There's nothing new about that. I'm glad you folks finally picked up on that theme, but you were kind of late to do it.
Well, on that note, we are out of time, unfortunately. So that conversation will continue.
Thank you.
Yeah.
Let me first say, for those of you who haven't worked on the Hill, John really is a superstar, long-term asset of the United States. And I can't tell you how much great work John and actually the entire staff that Senator Warren has assembled. She is still, in many ways, a professor. I say that as a compliment. She has high standards. She doesn't just wonk out. She's a very serious legislator, professional, and she is tough in picking the best staff, and she's done that. So, John, thank you very much, and thank you to all your staff who work tremendous hours under arduous conditions. So we appreciate that. The other thing I wanted to mention, just so it's clear to everybody, we also invited the staff directors, the Republican staff directors of the Senate Banking Committee and the House Financial Services Committee. I don't think you're here. But to some extent, you're hearing from the ranking member, Senator Warren's staff, but not by choice, but not by our choice, but by their choice. As I said earlier, financial reform and economic policy is too important to be partisanized and too important not to be talking to each other about. And it's to the country's detriment that that's the case. We tried not to have that the case. And I know Senator Warren, John, and the entire staff work very hard to put country first, to come up with solutions and make compromises to get the job done for the American people. And we applaud you for that. And we look forward to great success coming forward.
Thanks.